Welcome to Talk Tickers, where we dig into the earnings calls to get you the story behind the numbers.
And today we are doing a deep dive into Banco Macro, ticker BMA. Their Q3 2025 call was, it was one of the most confusing quarters I think we've seen all year.
Absolutely. And that's our mission today.
Yeah.
To solve that paradox for you. The bank posts this huge headline-grabbing loss. I mean, an operational disaster.
A total disaster.
And yet the stock barely moved. So we need to unpack what happened, look at the hidden strength on the balance sheet, and figure out why the market bought into management's really aggressive guidance for 2026.
Let's start with that headline shock, because it's important to understand just how bad the numbers looked on the surface.
Okay, so lay it on us. How bad are we talking?
Well, the GAAP EPS for the ADRs came in at a loss of 39 cents.
A loss. And consensus was what?
Consensus was for a positive 67 cents. So that's not a miss. That's a $1.06 gap. It's a crater.
Wow. Okay. And locally?
Locally, it was a net income loss of about 33.1 billion pesos. I mean, in almost any other context, a report like that would get a stock just hammered.
But it wasn't. The stock dipped, less than 2% during the call itself? So why did the market give them a pass?
Because the pain was all on the income statement. The underlying business, the actual volume, was booming. Revenue actually beat consensus by nearly $80 million.
So you had this collision, great top-line growth, hitting a wall of one-time costs.
Exactly. And the market chose to focus on the growth.
All right, let's get into that. Management called Q3 a perfect storm. What were the clouds that made up that storm? I assume the biggest was credit quality.
That was the big one, yeah. An unexpected jump in non-performing loans, or NPLs, and that forced them to set aside a huge amount of money for potential future losses.
Provisions. And when you say huge,
I mean, they were astronomical. Loan loss provisions just soared to 158.6 billion pesos. That's up 45% from just last quarter. And get this, up 424% from last year?
400%. Okay.
Yeah.
That's not just provisioning. That's a full-on clearing of the decks.
That's exactly what it was. It pushed their cost of risk for the quarter up to a really high 6.5%.
And where was the bleeding worst?
The consumer segment? Definitely. NPLs there jumped from about 2.8% to 4.3%. That tells you the average person is really feeling the squeeze from high interest rates and volatility.
Okay, so that's part one of the storm. Part two was margins, right? The net interest margin got crushed.
Crushed is the right word. NIM plummeted to 18.7%.
And it was at, 23.5% just the quarter before?
It was. Management blamed the, and I'm quoting here, roller coaster local interest rates. Simply put, their funding costs for deposits went up way faster than what they were earning on loans.
And then there were some other sort of voluntary hits they took.
Right. They booked some extra expenses for early retirement plans, some severance, basically cleaning up operational costs for the future. Plus, their bond portfolio took a bit of a hit from market volatility.
So the whole story from management was, we're taking all our medicine in one go, in one really ugly quarter.
Exactly. Clear the deck for what comes next.
Which brings us to why the stock was so resilient. The market looked right past that messy income statement to the balance sheet. So what's so strong there?
Well, if you strip out that temporary provision shock, the bank's actual engine is running incredibly well. Total financial assets are up to 10.1 trillion pesos. That's 69% year-over-year growth, real growth.
And I saw a really interesting pivot in their loan book.
Yes. This is key. Their peso-denominated loans actually went down a little bit, but their U.S. dollar financing shot up 10% in the quarter.
Which is a huge strategic move in an economy like Argentina's. Dollar loans are just safer.
Much safer. It shows they're prioritizing asset quality over just sheer volume.
And on the other side of the balance sheet, funding, how are they looking?
Also very strong. Total deposits are up 11% year over year. But the really critical detail is the type of deposits.
The cheap stuff. Checking accounts.
Exactly. Transactional accounts, which are very low cost, now make up almost half, about 49% of their total deposits. That's a massive competitive advantage.
Speaking of advantages, let's talk about their capital, because this seems to be the core of the bull case.
It is. It's almost unbelievable, frankly. They are sitting on 3.3 trillion pesos in excess capital. To put that in perspective, their Tier 1 capital ratio is 29.2%.
29%. Just remind everyone, what would be considered well-capitalized for a U.S. or European bank?
Oh, a big global bank would be very comfortable in the 12 to 15% range.
So they've doubled the cushion.
More than double. It's a fortress. It gives them the firepower to withstand basically any shock. and, more importantly, go on the offensive with M&A.
Okay, so that's the setup. The market ignored the bad quarter because the balance sheet is a fortress and growth is strong. Which brings us to the guidance. How do they get from this quarter's loss to where they say they're going?
It all starts with them saying that the worst is over for credit quality. They explicitly guided that NPLs and cost of risk would peak between Q3 and Q4 of this year.
So the cleanup is done.
The cleanup, they believe, is basically done. And for 2026, they're guiding that cost of risk to fall back to a more normal 5% level. That's step one.
And what does that do for profitability? What's the roadmap? Near term for Q4.
A big snapback. They're guiding for profitability to return to the levels we saw in Q2. They expect NIM to recover back towards that 23.5% level. If they hit that, they think they can still achieve their 2025 goal of an 8% real return on equity.
And that word real is so important here because of the hyperinflation accounting, right? Can you touch on that?
Absolutely. So under IFRS rules, in a hyperinflationary economy like Argentina's, you have to constantly restate your financials. It creates a lot of noise, and it can really mask the underlying performance.
So they focus on real ROE to give a clearer picture.
Exactly. They're trying to show investors what's happening without all the accounting distortions.
Okay, that makes sense. So moving on to 2026, which they're calling a transition year.
Right. For 2026, they're forecasting huge real volume growth, 35% for loans, 25% for deposits. They see ROE recovering to the low teens, still a transition, but a big step up.
But the real anchor, the number everyone is focused on, is the long-term goal. 20% sustainable ROE by 2027.
That's the target.
That seems incredibly ambitious. What has to go right for them to hit that?
Well, the whole thesis relies on one thing. Volume growth has to outpace the natural decline in margins. They expect NIM to settle in the mid-teens long term, so to get a 20% ROE, they just need massive scale.
And that scale comes from?
It comes from the big structural story in Argentina. The country's loan-to-GDP ratio is still below 10%.
Which is tiny.
It's incredibly low. So if the economy stabilizes, there's just enormous potential for credit growth. That's the engine they're getting on.
Okay, let's circle back to that massive capital pile.
Yeah.
What's the plan for deploying it?
Priority number one, no question, is M&A. Mergers and acquisitions. Management was very clear they plan to use that excess capital over the next 12 to 18 months to buy smaller competitors.
And we also got a really telling detail about buybacks. They stopped.
Yes, the 225 billion peso buyback is paused. And the reason they gave was fascinating. They said the stock price, and I quote, skyrocketed after the recent election rally, and it's just not an attractive price for them to be buying back their own shares.
That shows incredible discipline.
It really does. They're not just going to spend the money because they have it. They're waiting for the right opportunity.
Okay, so let's tie this all together for the investor. The market's mild reaction to that huge EPS miss. It tells us what?
It tells us the market is completely looking past 2025. Investors are anchored to the 2026 and 2027 story, the 20% ROE target, and the M&A optionality that comes with all that capital.
But the more skeptical analysts are still cautious. What's their main concern?
They're worried that the combination of hyperinflation accounting, currency risk, and rising competition from fintechs could keep that true ROE below 20%. They're basically saying that for the plan to work, macro needs a perfect, durable recovery in credit, which is still a big macro if.
Okay, now it's time for our favorite segment. This is not financial advice. A reminder to everyone listening, please consult a financial professional. This is purely for educational purposes.
The disclaimer is noted.
Here's the setup. You've got a bank with 3.3 trillion pesos in excess capital. M&A is their top priority.
Yeah.
And they're so disciplined, they paused their own buyback because the stock is, in their words, too rich.
Right.
That tells me the next big move in this stock won't come from a clean quarterly report. It's going to come from a major catalyst, a capital deployment catalyst.
So we're betting on the M&A story.
We are betting on the M&A story and on management's patience. The trade idea is the M&A optionality calendar spread.
Okay, break that down for us.
It's a way to bet on a far-off event. You would simultaneously sell the 2026 mid-strike calls. You sell those because their price is probably inflated from the stock's recent run-up. You're monetizing that near-term hype.
And then you use that cash.
Use the cash you just collected to buy the 2027 mid-strike calls. You're essentially swapping expensive short-term volatility for cheap, long-dated optionality on that M&A catalyst.
So you get a low-cost, high-leverage bet that they announce a great deal sometime in late 2026 or 2027.
That's the trade. It's a pure bet on disciplined capital allocation paying off big down the road.
A very focused thesis. I like it.
So To wrap up our deep dive today, Q3 was the painful but necessary cleanup quarter, a headline loss driven by huge provisions and margin pressure.
But the underlying balance sheet is, as we said, a fortress. Massive capital, cheap funding, and strong real growth, especially that smart pivot into dollar loans.
The big question remains, though, can that huge potential for credit growth in Argentina really be enough to offset declining margins and get them to that 20% ROE target by 2027?
And that leads us to our final thought for you to take away. We've talked a lot about M&A as the big catalyst for all that excess capital. But what if something else happens first? What if there's a major regulatory liberalization event in Argentina? What if the government drastically eases banking rules or removes currency controls? Could that sudden freedom be an even bigger catalyst for BMA than any acquisition?
A great question to end on. We appreciate you tuning in to the deep dive.